When the time comes to close a real estate transaction, there are some important calculations to be completed. First, there's the matter of taxes, fees, and costs that need to be split up or prorated between a buyer and seller. Real estate isn't often sold on the first of the month. However, a lot of costs from rent to utilities to homeowners' fees are due at the beginning of the month. This creates a problem since the seller has paid the monthly cost but won't actually occupy the property for the full month. At the same time, it's not fair to make the buyer pay the whole monthly cost either. To solve this, the monthly payment is divided up based on the date of the sale. The portion of the monthly cost that applies to the part of the month coming after the sale is added to the money owed by the buyer. There is a formula used to find these prorated costs. Tax, or fee rate, multiplied by remaining days equals the tax or fee owed. Here's an example. A house is sold on April 12th. The local homeowners association assesses a monthly homeowner fee of $120. Vera, the seller, paid the homeowner fee on April 1st. Greg, the buyer, owes Vera money for the remaining days in the month since she won't own the property after the 12th. The amount of money that Greg owes Vera is found with this formula. Remember, fee rate multiplied by remaining days equals the tax or fee owed. We can start by determining the remaining days in the month by subtracting the sale date from the total days in the month, in this case, 30. This leaves 18 days of fees owed to Vera. The fee rate is $120 per month, but we need to know how much is owed per day. So we divide the fee rate by the number of days in a month. Again, we'll use 30. Now we multiply the fee rate per day by the remaining days in the month, which means Greg owes Vera $72 at the closing. In most real estate transactions, the total money a buyer will need to bring to the closing is made up of the down payment and closing costs. So before we get to how we calculate the buyer's total obligation, we need to talk about these two concepts. In most cases, the buyer doesn't cover the entire price of a property all on their own. The majority of the price will be handled by loaned money. Despite this, a buyer is still expected to handle some of the cost. This comes in the form of down payment. The amount of the down payment is normally a percentage of the purchase price. When calculating the down payment, we use this simple formula. Purchase price multiplied by the down payment percentage equals the down payment. Now let's talk about closing costs. These are the various fees and costs that are incurred during the transaction process. Closing costs include costs like inspection costs, attorney fees, escrow deposits, and recording fees. Who pays those closing costs is something that will be negotiated between the buyer and the seller. So now we can find the buyer's obligation by using the following formula. Down payment plus buyer's closing costs equals buyer's obligation at closing. If you don't have the down payment amount, but you know the purchase price and the down payment percentage, you can use this formula. Purchase price multiplied by down payment percentage plus closing costs equals buyer's obligation at closing. Let's go through an example. Irving is in the process of buying a small house in the country. He and the current owner, Dana, agree on a price of $362,000. Irving's local bank has agreed to loan him money for the purchase as long as he provides a down payment of 10%. Over the course of the transaction, Irving has incurred $3,500 in costs. To figure out Irving's obligation at the closing, and because we don't have the actual amount of the down payment, with values inserted, the formula looks like this. Before we start working the formula, we need to convert the percentage into a decimal. So now we have the following. Now we find the down payment by multiplying the purchase price by the down payment percentage. We'll now add the down payment to the closing costs. So Irving will need to bring $39,700 of his own money to the closing. Figuring out the amount the seller takes from the sale of a property is similar to figuring out a buyer's obligation. Mainly, you're adding the money coming in and subtracting the costs of the transaction. So the seller's proceeds are like this. Sale price plus buyer reimbursement for prorations minus the seller's closing costs equals the seller's proceeds. Let's say Olivia is selling a commercial warehouse. The price she agreed to with the buyer is $688,000. On top of this, the buyer owes Olivia $6,440 in proration payments. By the closing, Olivia owes $3,500 in closing costs. To find the proceeds Olivia should gain from the sale, we use that formula, and with the numbers inserted, it looks like this. We start by adding together the sale price and the buyer's proration payments to get $694,440. Then we subtract the closing costs Olivia has incurred. Olivia should gain $690,940 from the sale of the warehouse. Of course, real estate agents involved in the transaction need to be paid for their services. A standard way of determining commission is to base it on a percentage of the sale price. When a commission rate is used, this is the formula that will be used to find the commission amount. Sale price multiplied by commission rate equals commission. Let's say a property sold for $740,000. The seller and their broker agree to a 3% commission rate. To determine the agent's commission rate, we use that formula. So, $740,000 times 3% equals commission. We start by converting the percentage into a decimal. 740,000 times 0.03 equals commission. And now we can multiply the sale price by the commission rate and get a total of $22,200 that was paid to the broker. Remember, commission payments are paid to brokers, but then the commission payment can be split up. This occurs if more than one broker worked with the same client, or the broker brought on salespersons to work as sub-agents on the transaction. In this situation, the division of the commission should be determined ahead of time. To determine the amount an individual real estate agent will earn from the transaction, we use this formula. Total commission multiplied by the agent's percentage share equals the agent's commission payment.